Hello, in this lecture we'll be working a problem that will be similar to the homework and or assignments. The numbers will change, the format will remain much the same. This will be the problem here. We'll be using this Excel sheet in order to work the problem. I do suggest putting the numbers into the Excel sheet because it can help you with the calculations. It's just good to know the Excel, and if you need to work a problem a second time, it will be easier to do so with an Excel sheet. Going back to the problem here, let's see what we have. Phoenix Company's 2005 master budget includes the following fixed budget report is based on expected production and sales volume of 15,000. So what we have here is a static budget report in the format normally seen, in that we have the income statement portion being sales less cost of goods sold gives us gross profit minus the selling and general expenses, bringing us to our net income. This is a budget, remember, a forecast, not the income statement of something that has happened in the past. Now what we're going to do is take that and prepare a flexible budget for the company at sales volume of 14,000 and 16,000 units, and classify all items listed in the fixed budget as variable or fixed. So our idea here is, of course, to take this fixed budget based on this fixed amount of units, convert it in such a way that it's not formatted in just terms of cost of goods sold, but in terms by the activity of the cost, meaning are they variable or fixed, so that we can have a flexible budget that will change more easily when we change the number of units that we are going to produce. We can make more estimates based on different production levels. Now the first thing I'm going to do is snap this on this side and put our Excel sheet on this side. I'm just going to do some data entry. I'm going to put this information into our Excel sheet over here. One, it's good to practice data entry, and two, it's good to have our numbers over here so that we can use formulas in order to work the problem. So sales is 3 million. Just going to plug that in. I'm going to put that in the outer column because there's no subcategory, as opposed to cost of goods sold, which then has these subcategories, which is indented in this format here, and therefore we'll put this into the enter column. These are not debits and credits. In this case, these are plus and minus formulas. We're doing this in order to sum up the columns. 975 for direct labor, machinery 225, and that was direct labor, sorry. Machinery 60,000, depreciation 300,000, and utilities 195,000, plant management 200,000. We have the underline there. Note that we could have a subtotal underneath for cost of goods sold, but in this case they're bringing it over to the right hand side. So this 1,955,000 is the sum of this column over here, that being the cost of goods sold. So we're going to pull this over here. There's a couple different ways we can show this in this type of form. So equals the sum of these. We're going to use our sum function. Whoop. I'm going to delete that. Equals the sum brackets of these items. And of course we could just add those up in a calculator. Sum function, one of the most basic functions we do want to use. However, we know that the sales minus the cost of goods sold will give us the gross profit. I'm going to do that with a formula here. This equals the 3 million in C5 minus the 1,955,000, of course, gives us the gross profit. We're matching our form here. I'm going to put formulas where they are relevant over here. Selling and admin. Once again, we have, these are period costs because they happen in the period rather than part of the production. And here we have packaging 75,000, 105 for the shipping, and sales salary 250,000. Once again, we're going to sum those up on the right hand side, being the total selling expenses. I'm going to say equals SUM, summing up the 75, the 105, and the 250, and enter. So then we're going to go down and do the general and admin, of course. 125,000, 241,000, and 90,000. And I'm going to sum those up over on the right hand side again. Equals SUM, and highlight these numbers, summing them up. There we have that. Now we had our gross profit, which was sales less cost of goods sold, minus these two other selling and general administrative expenses. So I'm going to say that equals the gross profit in C13 minus the selling minus the general and admin equals the 159,000. There's our numbers here. Only other numbers I need to pick up from this worksheet, and then we can just full size our screen, is the fact that our budget wants a production not at the 15,000, which is what this is based on, 15,000 units, but we want it at 14 and 16. So I'm going to go ahead and make this large. I'm going to put those in here. I'm going to have a new flexible budget at 14,000 units and a flexible budget at 16,000 units. And so now our goal is to take this format, convert it to a format that's not in terms of cost of goods sold and then period costs, because the cost of goods sold includes both variable portions and fixed portions of expenses. And so when we change the volume, that can be very confusing for us to keep it in this format to have a budget that would change with the volume level. Therefore, we want to convert this format to variable costs and fixed costs, no matter if they're part of the cost of production or period costs. We're going to put them into this format. Remember, this is not the format that we will use on financial statements. This is an internal format that is useful for internal type of predictions. So this is managerial accounting. So if we want to see what the sales is per unit, then we could say it's going to be this 3 million divided by the number of units that we estimated this budget to be on, and therefore we're going to have 15,000. So we have 200 per unit. So that's our per unit sales. The variable cost, we can do the same thing. If we're saying direct labor, the total cost equals the 975, then we're going to divide that by the number of units we believe we're going to produce, because they change in relation to those units. And we're going to say that's 15,000, so we get 65. Direct labor, same thing. I'm going to take this direct labor. I'm going to divide that by the number of units that the problem told us we were producing at, 15,000, and we get 15. Machinery repairs, same thing. It's a variable cost. Therefore, 60,000 divided by 15,000 gives us 4 per unit. Utilities, a little bit different now. Note that what utilities, note that we skipped depreciation here. Why? Depreciation is a straight line method, and therefore it's the same each period. It doesn't vary with the level of production. Therefore, it's not in the variable cost section, it's in the fixed cost section. Utilities is a mixed cost in this case, in that it has a 45,000 variable portion. The rest is the fixed portion. So when we think about utilities, we got to take equals just the 45,000 variable portion, which changes with the level of production, divided by the 15,000 units. So the variable portion is 3. On the packaging side, we're going to say, now note where packaging is. It's down here in the selling expenses. So even though it's in the selling expenses, it varies with the level of production, and therefore we're going to take that divided by the 15,000 units, because it changes. And then we're going to do the same for the shipping, because it's a variable cost apparently. So we're going to take that 105 divided by 15,000, and those are our variable costs. I'm going to sum up the variable cost now by saying this equals the sum of, remember not to pick up the 200,000, that's the sales price. We just want the variable cost of the 65 down to the 7. 65 plus 15 plus 4 plus 3 plus 5 plus 7 is the 99. Our contribution margin, remember again, contribution margin not in financial accounting. It's not over here in financial accounting, but it is very useful in managerial accounting, because it tells us what we're taking away after variable cost, meaning the formula is equals the sales price, 200 per unit, this is a per unit contribution margin, minus the 99. So we're coming away after variable costs of 101. That's a very useful number to managers, because then they can think about how many of those units they have to sell to cover the fixed costs, like the rent. So now let's go into our fixed costs down. Now note that the fixed costs are a lot easier in a lot of ways, because they don't change. Something like the rent stays the same every time. So no matter how much levels of production we have, something like the rent, we still pay the same level of the rent. That's why we're breaking them out by behavior. So if we go down to the depreciation is going to be the same. So the depreciation is 300,000. Doesn't matter if we produce 15,000 units, 16,000, 14,000 units, or 16,000 units. Doesn't matter. Utilities, we had a mixed cost. It said that the total was this 195, minus the variable portion of 45,000 means that the fixed portion must be 150, because the 150 fixed portion plus the 45,000 variable portion would equal the 195 total utilities. Plant management fees, manager gets paid no matter what, how many units are produced. So we get the 200,000 there. And then we have the sales salary. Once again, we're down here in the general and administrative, or the sales and general administrative, the period costs, and that's a fixed cost of 250. It doesn't change because it's a salary, not an hourly wage. And then we got the advertising, also a fixed cost. It's down here, and that's the 125. Then we have the salaries on the general side. Most of the office salaries, once again, don't change. They're not hourly. They don't change with the level of production. Entertainment, it apparently is not going to change, of 90,000 there. And so we are then going to have our total fixed costs. I'm just going to sum these up. So we'll say this equals the sum. The sum of the 300, the 150, the 200, the 250, the 125, the 241, and the 90. All right, so now we're going to basically make our two budgets based on the 14,000 sales volume and the 16,000 sales volume. So if we say that sales is 200 per unit and we make 14,000 of them, I'm just going to say we have 200 units times 14,000. That gives us sales of 2,800,000. These variable costs change in a similar fashion, meaning we're going to say the 65 per unit cost to direct materials times the 14,000, enter. We're going to equal the $15 per unit times the 14,000, enter. We're going to take the machinery and equipment of $4 per unit